topic. As you are aware that in last 4.5 years, we have organized 187 webinars on different topics, invited various regulators, industry experts, and the prominent people and professionals. And they have collectively given their knowledge and information about the market and what is happening, they have discussed. Friends, today's topic is very important in today's scenario because this topic talks about the inorganic acquisitions. Now, this is a very strategic purchase of companies or business to achieve growth. And this is also a very powerful tool for business looking to expand their market, reach, diversify their offering, or gain competitive advantage. In current economic landscape, companies are increasingly leveraging inorganic growth strategy to navigate market uncertainties, capitalize on emerging opportunity, and achieve faster growth compared to organic method. As you are aware that when we are doing something on the organic basis, the development is slow. No doubt it may be steady, but till the time the way market and competition is so market is very, very competitive. If you are delaying your thing, you may lose market. So today it is not important that you have some good product. The importance is also that how fast you are moving to the market. Now this webinar we will deal upon the evolving dynamics of inorganic acquisition, examine the latest trends, because by explaining and giving example and what is happening, which you have experienced, you can realize and you can understand that how these things are very important, because live example gives a live understanding. Now, we will also discuss the other than trend, what are the consideration, what are the best practices, and what are the things which can make a transaction successful. We will also explore how companies can effectively identify acquisition, target, navigate regulatory challenges, because whenever you are acquiring something, regulatory aspects is also important, legal aspects are also important, cultural aspects also important, and various jurisdictional law and their need is also very important. Now, we have to see this. When you do this, what are the regulatory challenge, integration, and various other things. And we will give you some live example also. So today, if we divide the entire topic, we will discuss organic acquisition versus inorganic acquisition, current trends in inorganic growth, key consideration in inorganic growth strategy, prerequisite for inorganic acquisition, and emerging market sectors for acquisition. Now, all these things will talk about the various aspects of business and how this trend can be helpful and to understand the various things in this. For this, today we have invited a very learned speakers for this. Those who are doing work day and night. First, I welcome Mr. Arun Malhotra. He is a founder and managing partner of CapGrow Capital Advisor Limited. He is an investment professional, has experience of 30 years in portfolio management, equity research, and trading. He has extensive investing knowledge across the entire capital structure chain, including direct equities, convertible bonds, high yield, distressed debts, and structural transactions. Arun runs a successful PMS, and because when you are a PMS a person, then you are managing money of other investor, then you have a dual responsibility. You have to maintain the return to the investor as well as maintain the his security also. So you should be knowledgeable, as well as you should have the complete command over the market, so the investors fund should grow. I welcome Arun for this program and your experience and your knowledge on this area, and how the companies has taken advantage. Your live things will helpful to our participants. Then we have Mr. Manoj Kumar, Partner Head, M&A Transaction Corporate Professional. Manoj will dwell upon the transactions issue and the regulatory aspects and various hiccups in this. Then we have Mr. Sanchit Vijay, Partner Head, Deals and Valuation, Corporate Professional. He will explain to you what is organic and inorganic growth and how the companies has live example he will share. Then we have Ms. Ruchika Sharma, Associate Partner, Corporate Professional. She will also discuss about the various aspects of inorganic growth and how you can sail smoothly in the process. Friends, this is our total speakers. The program structure will be first and tell us the practical things and difference between organic and inorganic growth. Then Ruchika will discuss about the other aspects of the transactions. And then Manoj will tell about the legal and regulatory aspects and various other things which is required for in this acquisition, inorganic acquisition. And then we will request Arun Malhotra. He will tell us live example of market, how these things can converted into wealth creation for the investor, and which is not created wealth for the investor, because every inorganic acquisition is not successful. It has some issues also, which we will discuss today. Friends, as you are aware that organic and inorganic acquisition is very simple point. Sanchit will tell you in detail, but in simple way, organic, you are developing in-house and slowly progressing. It takes time. But inorganic, what you are doing, you are taking over the running business. So the entire business, entire market, entire customer, entire production capacity, everything added on day one when you are acquiring, and you can take advantage. So we have seen Reliance Jio. It's a good example, which they have developed organically, and slowly they have developed infrastructure. So in 2003-4, we came to know that Reliance is putting the lease line. So you can understand it took 20 years to reach to this level where Jio is standing today. But it is a slow. But if you see the inorganic growth, the example is Tata Group. They have taken over Jaguar Land Rover. No doubt they were in the very bad shape when they had taken, but Tata, with their capability, they have changed the entire structure, and today Jaguar and Land Rover, it's becoming a I think in Tata Group, maximum profitable business is there, and which they have taken. So entire world market, entire distribution network, everything they got it in one go when the deal was finalized. Otherwise, if they were expanding Tata Motors to other part of the world, they must have taken so much time. Now, if today what is happening, it is not inorganic growth, is Indian context, cross-border acquisition is also taking place. So Indian companies are continuously pursuing acquisition outside India, because now cross-border acquisition merger is allowed. We can take example of SCL. SCL acquired IBM software product in 2019 for $1.8 billion, and it helped gain intellectual property and expand its product portfolio in the global technical market. That is another example. Then we have seen pharma, IT, or inorganic acquisition are common strategies scaling up the business. Sun Pharma acquires Ranbaxy in 2014. So including Sun Pharma and Ranbaxy, both are in the same line. They become the largest manufacturing company of pharma in India and top 5 in global. So that is in one go, they have reached the market, they have reached the production, and they have expanded the products also. Then private equity and startup, they are now increasing activity from private equity firm, and startup has fueled M&A deal, because today various niche area people are doing this. Like you remember, there was a company Sesam that is on identifying the music which you just connect. Now Apple has taken over. So Apple could have made this, but naturally, when the Sesam they have acquired, the business as well as customer also came to the Apple. And here, like in private equity and startup, they are small, but they have some niche area. So we have seen the Zomato acquire Uber Eats, because Uber were doing this business also, but they were not successful. So they have sold because they have exited in the market relating to this. Now the point is, these are some example I have given, but what are the key consideration when you do this? Number one, it should be strategic fit. Indian companies often look for a synergy like technology or market access. That is a one important part. Like take example, Reliance. They acquired Future Group and Netmits. Both the things were in retail and e-commerce business, and they have added in the Reliance retail umbrella and creating diversified in both the area. Future Group, they have a various product, various things. They were selling everything, and Netmits is a medicine, so they have merged. Now, this is strategic fit because they have done. Next is due diligence. So whenever you are doing this, due diligence is most important. Rigorous due diligence, rigorous financial, legal, and operational due diligence is very, very important, and it is crucial. We have seen example of Bharti Airtel acquire the Jane Africa 2010, and they faced lots of challenge. Regulatory issues were there, high operational cost was there, so their business was not viable. For this reason, the Indian market of Bharti Airtel and the capital market is also taking it negatively. But after some time, when they realized this and they have corrected, and now because of this, they have accessed the entire South Africa market. Then next strategical issue is cultural integration. That is also very important. Sometimes you are doing some acquisition, but problem is that you're not able to manage and meet out. They take example of Vodafone India, Idea Cellular. In 2018, created the largest telecom company in India at that time. But it faced cultural and operational problem and integration because the Vodafone was UK based and this is Idea Cellular India based, and they had lots of issues. And because of this cultural integration issue, they lost market. And today they are in number 3, and the Jio and Airtel, they are far ahead than this company. And we were expecting when Vodafone is doing something, they will become top most company in India also. Now, when we do inorganic acquisition, then we should think that what are the prerequisites. So number one, clear acquisition strategy should be there. You have to understand what is the purpose and what is the long-term plan. Like take example, Infosys acquired the digital transformation, and because they acquired various company like Brilliant Basis in 2017, and that is because of this, their enhanced design and customer experience service, they increase. Then regulatory compliance. Sometimes what is happening, the regulatory, like in India, CCI is there. So whenever you are doing some acquisition, some inorganic acquisition also, then you have to pass that test also. So CCI intervention in Walmart, Flipkart deal has created problem, and that is because that regulatory compliance is there. Now, these are certain points. If you see the Indian market, emerging market, and sector for acquisition, then what is happening? The South Asian market, especially India, and where their population is more, what is happening? The other companies, those who have established brand, they want to come in and create inorganic acquisition and want to access the market of India. Like take example of Baidu. Though it is an Indian tech company, but they acquire offline business of Akash. They acquired Great Learning. and that's why they have expanded. Same way, in pharma, Cipla has acquired South African based Myron in 2018, and they increased their presence. Then, if we see whether this type of acquisition are good or not, or are successful, then we have seen Reliance Industry has taken over Hathway and Den, which Sanchit will explain you in detail. And because of this, that had added in their telecom and digital ecosystem. Tata Steel acquired Chorus and now Chorus is a Tata Steel in 2007, and they become the global player in the world. And Chorus was facing problem. Tata has turned around this. Then Ola has taken over the Etilgo. This is a Dutch electric company in 2020. It boosts its capability of electric mobility space. And because of this, they have created an importance and capabilities in the Indian market, and they are readily available for the foreign market. So friends, these are certain background I have told you. Sanchit will explain to you in detail. Then all these acquisition, when we talk, it is not straightforward. You have to just see strategy. You have to see due diligence. You have to do proper due diligence. It's not a financial or legal. You have to do cultural also, and various other country based also, and the various structure, because geopolitical issue, if you are acquiring international company, that is also you have to focus. And integration, how integration will be good or bad, you have to see. So you have to navigate the entire aspects of this complexity of inorganic growth. Something you are creating, you face the slow growth, but when you are taking faster growth, you follow inorganic acquisition. But these are things you have to see. But these things, not only the strategic part, but you have to see the tax aspects, you have to see the legal aspect, you have to go for the court process, you have to see the cost aspects of asset stamp, accounting standard point of view, your culture, another culture. You have to see the financial restructuring. You have to see some company has a loss making, so how to acquire this. Then you have to do the swap of shares also sometime. That is also possible, that your capability to fund is not possible and you are not getting fund because in India, banks are not financing. So all these things we have to understand to make it successful. So friends, all points which I have given you indication, today we will discuss, and our team will tell you how to navigate this, how to take advantage of best practices in this. So this is background, but I want to announce a very good news for all of you. Today we are launching our new website. We have a transaction advisory division where we have a deal and business structure, separate vertical. In this separate vertical, today we are launching our new website, which is connected to our inorganic growth. Company wants to acquire one business wants to acquire another business. So there is a discussion, but we want to bring out a platform where anybody can put their deal, and they can, if they want to buy, they can see from our database. And if you want to sell, you can log in and post your deals in this. So we will provide a customized, when you will, this is one platform, we will create matchmaking. Next is that if you have some company and you want to sell, but you don't know how to do this, or if you want to acquire a company and you want to take our help, we will provide you all strategic advisory and business planning, deal advisory, corporate finance, IPO advisory, merger acquisition and valuation, and that we will do. So now I will request Sanchit, please release this website, because that is your baby, and I will request Arun also to just see. Then Sanchit should explain about this website and launch it.
Thank you so much, sir. I'll just share my screen and launch the website. It was supposed to launch today in our webinar at 4 p.m. and it is now live for all public from today 4 p.m. onwards. So this website is by the name dealforbusiness.com. It's basically a platform for anybody who's looking to do any acquisition, who's looking to acquire any distressed opportunity, who's looking to fundraise, who's looking to sell their business, all of that. So it will unlock the acquisition M&A deal platform market. Uh, and along with that, we will be providing our end-to-end solutions. Our services with this platform encompass the deal navigation factor, execution, and the expert matchmaking as your trusted investment banking companion. So this is the front page of the website
Sanchit, little
where
bit louder. Sanchit, little bit louder, please.
okay. Is it fine now?
बेटर बट थोड़ा सा
Yeah.
और बोलना है.
Okay. So this is the front page of the website where anybody who comes here can have a look at what the hero page tells about. He or she can explore deals through this. But before, I will tell you about what exactly is there in the website. You can explore all the transactions that have been listed here, or you can list your own transaction through your list your deal. So for example, these are all the live transactions that we have with us. If I tell you, these are all hot transaction, exclusive opportunities with Deal for Business. Let me just take an example. Let's say this is a company in the industry of packaged foods located in Maharashtra, which is available for sale. A brief description, two-liner would be given out about explaining what the deal is about and what the transaction is, along with certain financial parameters, which will just give a brief insight into what the company is. Any person who is interested in this deal can simply log in and similarly take all the information of this deal with them. They can also download the teaser of this transaction, contact us on the WhatsApp, or contact us on email as well. So this is one thing that they can do through this transaction. Again, there are live deals also. It's a three-step process. Any opportunity that you explore, you can dive into the details of that respective opportunity and you can express interest to us and we will connect you with the relevant person. I will now take you to all our live deals that are being listed here. We have deals primarily categorized into three parts. Firstly, businesses that are available for sale, businesses that are seeking funds, and buyers or investors who are looking to either acquire business or are looking to invest into any company. You can easily filter out whatever transaction that you are looking at. For example, these are active transactions that are looking to raise funds. All the revenue information related to the company is here. You can select whichever transaction, you can mark it as favorite, you can share it, you can download the teaser, you can contact us on WhatsApp, you can easily reach out to us for any transaction that you feel interested in. You can also select the type of company that you are interested in. You can select the industry, if at all, that you are interested in, and similar click on filter, and that is how you can easily get whatever transaction that you're looking for. For example, this is a diversified FMCG, a leading manufacturer of private label hygiene product, which is looking out for 100% sale out. The top line is 15 CR with a EBITDA margin of 40% and deal value in the range of 40 CR. You can contact us, you can download the teaser, you can share the teaser with yourself, with your connects, or any relevant person that you feel. And all our transactions are listed out here. Along with this, You can read through our FAQs about what exactly is it is about deal for business. How do you explore deals? What is it about deal posting? How can you connect with us? Now coming on to the next factor, these are all the transactions that have been approved by us and are listed on the platform, which are live, and anybody can look into these details. You can also list your deals. You can list your deals. I'll just log in it up. Just a second. Hold. Hello. Yeah. I'll just log in and but in the meanwhile, I'll tell you about what all exactly other services along with this deal for business that we provide. We provide end-to-end negotiation, any strategic advisory that you would have with respect to acquisition, the deal advisory fact, the corporate funding that there may be, M&A activity, IPO advisory, along with valuation. That means a complete end-to-end deal life cycle is what Deal for Business can support you with. The website is live now. Apart from that, we have a monthly deal wire that we release. Any person who would like to receive this deal wire, which is a snapshot of all the transactions of buy, sell, and funding, which are listed on our website, you can receive that in your email as a mailer, and you can subscribe it through the website itself. You can also join our WhatsApp group. Again, all the transactions that are listed out on the WhatsApp group and a lot more are shared on daily basis on our WhatsApp group. You can very easily click on the join now button of our WhatsApp group and get added into our deals and startup funding. All the opportunities with respect to buying and selling and funding are posted on this WhatsApp group. We have a network of 10,000 people sharing deals on daily basis across various industries. You can also partner with us so that we can network together on any of the transaction for either buy side or sell side. We post regularly articles also with respect to investment banking on our website. You can read through that and you can reach out to us through that as well. So that is all about the website Deal for Business. It is live now. You can go to the website, you can have a look at it, and you can see if there is any transaction that you would be interested in, and you can reach out to us.
Okay.
Thank you.
Thank you, Sanchit. Thank you very much. And congratulations for launching this website. It will be very useful for the Indian market. Now, friends, as you have seen, the corporate professional has launched a new business vertical, adding in the deals and business structuring, the technological part. It will helpful. So use this, suggest your suggestion. If you want to become the partner, you can log in and you can suggest. So with this, thank you very much. Now I will request Sanchit to give presentation on this. But before that, I just want to announce our next webinar, 189 webinar on corporate proxy advisory firms, champions of corporate governance, or they are the champions or they are the obstructionists. They create obstructions that we will discuss on 13th September with all of you, because proxy advisory is becoming very popular nowadays, and they interfere in every company's transaction on behalf of investors, on behalf of the big players. Over to you, Sanchit, for your presentation about today.
Thank you so much. So we'll talk about the inorganic acquisition. What exactly is inorganic acquisition? What is exactly organic growth? So let's talk about what are the different types of business growth. There are primarily two types of business growth. First is organic growth, and second is inorganic growth. Organic growth is when the growth is achieved by the business on its own efforts and business operations. And inorganic growth is when there are external factors involved, probably using M&A activity to grow the company inorganically. What exactly is the difference between an organic growth and inorganic growth is?
Your screen is not visible.
Okay,
You have
just hold on a
started
second.
sharing, but it's not coming.
Is it
Now,
visible now?
yeah.
Okay, perfect. Okay, I'll start again. So we started with organic growth when the growth of the business is achieved by its own efforts and business operation. And inorganic growth is when the growth is achieved by external factors like M&A activity. What exactly is the difference between organic and inorganic growth is that inorganic growth is a faster method of growing and expanding existing business, whereas organic is a gradual expansion, which is relatively slower. Uh, the growth potential in the inorganic side is very significant and rapid because it immediately increases the market share. You get immediate technology, customer base expansion, and a lot of top line, bottom line also gets added to that. Whereas organic is very steady and incremental, it is driven mostly by internal efforts. Control. Whenever inorganic growth happens, there are diversified management expertise and capabilities that join hands. Whereas in organic, it is mostly managed internally. With respect to flexibility, inorganic growth quickly adapts to market changes through acquisition. There is a strategic advantage over it. Whereas in organic, there is high flexibility. It is easier to adapt changes from that standpoint. Market penetration in organic growth is very steady. It focuses on existing market and growing slowly and steadily in that similar market. Whereas inorganic growth gives rapid access to new market and geographies. So we would be talking now about what are the different trends of inorganic growth that takes place. Uh, these are M&A deal trends that have happened in India and globally over the past year. M&A deal value in India was at $136 billion, which is forecasted to grow multifold in the coming years. Uh, Continued business and investor confidence will definitely pave way. And as you can see, that the growth in terms of both deal value and volume is growing enormously. There are certain insights about the M&A activity in the recent year. Since 2010, basically in the last 15 years, about 5 lakh M&A deals have been concluded globally, of all sizes. Starting from 2016, the overall M&A deal fluctuated slightly, but by the end of 2021, it drastically increased to 63,000 M&A transactions in India. Overall, the value of M&A in business has amounted to almost $6 trillion. Obviously, it is expected that the annual growth rate, the CAGR, is at 19.75, which is resulting in a total amount of around $45 billion by 2025. India's regulatory environment plays a very crucial role in shaping the M&A landscape, and that is what we're going to be talking about in the coming slides. Sector-wise trends, if you can see, most of the top sectors that where deals takes place in terms of volumes are retail and consumer, IT and enabled services. Whereas in terms of the deal value, it is mostly pharma, healthcare, biotech, and manufacturing side. With respect to various sectors that are very hot in terms of M&A activity are the financial services, the technology, media and telecom, the energy sector. All of these sectors have encountered various M&A activities in the past years. I'll be taking certain examples in the following slides. Uh, Construction and transport, medical and pharma, industrial manufacturing are mostly sectors where M&A activity take place in terms of deal value. Acquisition as a growth strategy. How is acquisition considered to be a growth strategy? Is that what we would be talking about? It is basically one of the best strategies for diversifying into new market and achieving more robust positioning in a very competitive scenario. Whenever you do an inorganic acquisition, you quickly enter new market. There you get diversified products. You acquire different intellectual property. You acquire top talent. You reduce competition. Uh, there you enter a marketplace with a lot of credibility. There is more value to the shareholders of the company. There could be innovations that could come through acquisition. And obviously, surprise competitions are definitely there, but you definitely reduce the competition as well whenever you actually acquire. Frequent acquirers are gaining a performance advantage over time. As a study by BCG, frequent acquirers have a 130% advantage in shareholder return over non-acquirers, which was 57% in the decade of 2000 to 2010. 70% of deals are now considered successful by executive, indicating improved efficiency. M&A activity has significantly increased over the past 2 decades, as I mentioned in the trends. Also, as cost of capital raises and competition for quality asset intensifies, companies are focusing on preparing for continued M&A success. So anybody who's looking to gain a performance advantage in terms of their market cap or shareholders' return, inorganic acquisition is a very great strategy for anybody out there. Let's take a few examples of certain companies who have done inorganic acquisition. And when I say inorganic acquisition, a chain of M&A activity over these past years. Disney is one such successful global name who has done M&A activity as a business growth strategy. Over the time, it acquired leading production companies like Pixar, Marvel, Lucasfilm, 20th Century Fox, and certain big M&A activity as per the date of acquisition have been mentioned here by Disney. With this, if you can see how the performance of Disney stock have performed with respect to the Standard and Poor 500 index, the stock of Disney has enjoyed a growth of 350% plus over this period, compared to just 61% for the overall market during the same period. Obviously, M&A activity did open a lot of doors for Disney. It helped Disney enter into various new markets as well. In 2005, Disney's revenue was $31 billion, and by the end of 2016, it had jumped to $55 billion because of inorganic acquisitions. Within the Indian landscape, Zomato is one such successful example where it acquired a lot of companies starting from Uber Eats, Blinkit, Hyperpure. With this, it has fueled its rapid growth. It diversified into food delivery, grocery services, B2B supply, and it expanded its market share and offerings. It is a very pivotal, this approach has been very pivotal in driving its success in the competitive food tech space. There's so much so that it is being said by Zomato that the company that it acquired, Blinkit, will probably be more valued than Zomato in itself. You can see that Zomato primarily operated as a food delivery and restaurant discovery platform, and company's revenue in 2018 was 1,400 crore approximately. And by 2020, in a matter of 2 years, it grew to around 2,700 crores. The acquisition of Uber Eats boosted its customer base and obviously driving rapid revenue growth. In 2022, the acquisition of Blinkit expanded its portfolio into grocery delivery. and pushing the revenue from 2,700 crores to 4,100 crores by 2023. In a matter of 3 years, it doubled, almost doubled its revenue. This compounded growth from 2018 to 2023 shows the impact of the strategic acquisition that it had on Zomato's growth strategy. A similar case we can see for Reliance. Reliance has been a pivotal example with respect to acquisition that it has done in the past, whether it's Viacom 18, whether it's Hamleys. It significantly increases a company's net worth, market value, and diversified itself into various other sectors. Obviously, reducing its dependence on petrochemical refinery, and this acquisition has obviously skyrocketed the revenue of the parent entity as well as the market cap. Adani again is aggressively focusing on acquisition strategy and diversifying across infrastructure, energy, transport, which has propelled both the revenue and net worth. Whether this growth outcome has led to significant increase in its it has saw a substantial increase in its revenue as well as net worth because of these acquisitions. Thank you so much. This was all about the inorganic acquisition. I would pass the mantle to Manoj sir, who would be talking about what are the key consideration, what are the prerequisites whenever we are doing any inorganic acquisition.
Yeah, Manoj, now
Yeah. Okay.
yeah.
Yeah.
Please explain, because Sanchit has given the acquisition part, but now you explain how to do this, because acquisition is not by saying acquisition, it looks very easy, but when you go in detail, what are the hurdles, what are the plan, what strategy you have to follow? Please tell us.
Yeah. Thank you, sir. Good afternoon, everyone. Thank you, Sanchit, for giving a detailed landscape of the current M&A in India specifically, and how it is important to have M&A strategy for inorganic growth of any organization. So let me share my screen first. So I think Sanchit has given in detail what are the strategies for acquisitions and why company go for inorganic growth path. So there may be various objects for going to public, going for acquisition of a company. So it may be generally we all know that inorganic growth is a faster way to grow. But what are the major considerations when a company think about going for acquisition of a business or a company? So one of the major factor is to consolidate in the market. So when a company start growing after reaching a certain level, it wants to grow exponentially, and that can happen either through organic way, but that may take much longer time. In place of that, it may go for consolidation through acquisitions. So consolidation in a particular market or to grow faster is one of the most important decision for company management to go for acquisition of a company. It may also help in increasing the viability of the business through vertical or horizontal acquisitions. So sometimes acquiring certain company which are providing the key component or key supplies for the growth of the company becomes very important, so that there is continuous supply to the for the growth. Similarly, it may be sometimes that you are getting very low margins because of you are stuck in between. So in that time, if you go for the vertical acquisition of the upper side of the spectrum, you may get much better margins in the business. So that will be one of the strategy. Similarly, horizontal acquisition, which is to grow in certain markets, certain geographies. Let's say you are in south of the country and you want to expand in your business into eastern side or north side, you may acquire certain similar competitive business in these geographical area. So that can be very good, important strategy to grow faster. It will also help to expand into new segment sometimes. So let's say one company is into personal care business. So personal care, it is right now in let's say cream, etc. And now they want to go into the men's grooming segment, or maybe in aerosol segment, perfumes, etc. So they may go for acquisition of the company. So this kind of adding new line of business would be very important for faster growth, because it will create a larger gamut of service segment under one roof. Then another aspect is, if the company has matured and want to access the capital market or access private equity, which are larger in size and don't want to invest in smaller size companies, it is become imperative for the company to grow faster. And for that growth, it is important to acquire another companies or increase the size through acquisitions. So making the size viable to attract the good size investors like private equity investors, or even in case of IPO to QIBs, etc., it is important to go for acquisitions and grow faster. If the company has planned to go to IPO, it would certainly like to have larger bouquet of service or larger bouquet of product line, and size should be bigger. So for that, it's a good strategy to go for acquisition and grow faster. Similarly, there may be situations when the company is going for listing or is already listed, and it can take advantage of leveraging listing leverage arbitrage, and keep acquiring the companies which are available in the market at a smaller P multiple or EBITDA multiple, and immediately post listing it can get much better value due to those additional EBITDA or additional P of the company which is getting acquired. Then one of the important aspect is the competitive advantages. So to create competitive advantage, creation of bigger size is always very important. Also, sometimes elimination of competition is also very important. For elimination of competition, certain companies are acquiring another company or brands, and then let the brand die over a period of time. That can be one of the strategy to grow faster and acquire larger customer base. Add newer technology and IPs are also important, specifically IP-based industries like pharmaceuticals or in IT company. So for IT companies, new technology like machine learning or data mining or maybe AI can be the technology for which acquisitions could be a very important aspect. And organically growing inside the business would be time consuming, so it is better to acquire. So let's say pharmaceutical company acquire certain patents or certain brands which will immediately add to their portfolio. So that kind of competitive advantage would be there. Similarly, there may be customer base. So there may be certain companies which are in tier 2 cities or smaller cities and now want to expand to the luxury segment. So they may acquire certain companies or vice versa. So these are the major strategies for which inorganic growth steps are taken by the corporates. So what should be the path of acquisition? So first and important aspect is to create the strategy. Why to acquire, which kind of things to acquire, what is the purpose of acquisition, what kind of investment company is willing to commit for those acquisitions. So that is the motive, creation of motive or creation of the strategy, which is the first step which the company should make first. And the criteria must be very, very clear so that there is no confusion what they are going to buy. Then searching of the target. So it's searching of target maybe by the company or company's officials themselves, or it may be through some investment bankers who can help them to acquire. So they should give clear strategy, what kind of business they want to acquire, what is the budget for this acquisition, what are which kind of target they should approach for. And based on that, the research should start. Then market, so the research will be there, which are all companies are available, which may be a suitable target to go further. Then based on that, from the public domain information, these research are done, and based on that, certain targets are decided. Then the outreach starts. People or investment bankers or the officials reach out to them and try to understand whether they are willing to get sold or get investment into that, strategic investment into the company. And that can happen either directly through the top management, or maybe sometimes through some consultants in between. So that will be the next step. If that happens, if some of the targets are willing to consider the discussion for M&A, then the meeting is set up, or introductory calls happen to understand the businesses, to understand the culture, to understand whether it is fit for the acquisition or not. Based on preliminary understanding, a broader offer is made by the buyer or potential buyer, and then the process of negotiation starts. When the commercial negotiation is conducted and the basic terms are agreed upon, that is the stage where the term sheet is signed, which may or may not be a binding term sheet for between the parties. And from there, the formal process starts. So there may be a need for signing of non-disclosure or confidentiality agreement, and then there will be diligence. So diligence will be majorly three kind of diligence are done. One is legal diligence, where all corporate affairs of the company, governance processes, legal cases, contracts, etc., agreements and contracts, etc., are reviewed by legal team, and they give their opinion about the worthiness of the company. Similarly, financial diligence is carried, where detailed understanding of the financials of the company, past performance, the authenticity of the numbers, authenticity of debtors, creditors, stock, etc., are done. And similarly, tax-related issues are also considered, and based on that, opinion is given by the relevant consultant to the company that this company's financials are authentic or can be considered for the purpose of acquisition. Similarly, operational or business related diligence is done. Generally, it is done by the management team or company's own people, who go deep into each of the plant and understand their efficiency. They also do some market survey to understand whether the product sale is genuine, or what is the opinion of the sellers or buyers relating to the products or services, as the case may be. So that is the another aspect, and which is very important to judge whether this acquisition would be worth. Then the actual work from after diligence, the actual work of acquisition starts. So it may be through simple acquisition of shares, or acquisition of business, or maybe merger. So those kind of deal is structured, and then deal closing happens. So the steps between 7 and 8 is quite long, and it is the actual process of acquisition. And then there will be some post-closing steps, which sometimes very critical also. So we will discuss that also. At the time of acquisition, these are the major considerations in hand the market. So for the management to take the decision regarding the acquisition. So target should be strategic fit. So first we have decided what kind of acquisition, what is the purpose of acquisition. So based on that purpose, whether this target is fit or not, that is just, and that is the basic preliminary thing to see interest in the company. If the target is strategically fitting to the company's growth path, then only further negotiation is required. Then second and very important aspect is the valuation. What is the expectation of the valuation of the seller, and what you are willing to pay? That becomes a very critical aspect. If there is minor difference, sometimes third party opinion is taken. So valuers are appointed. They carry detailed diligence based on that. They give their opinion. What is the right value for the business or the company? And then if the valuation is reasonable and acceptable to the buyer, then the next part is coming for the is how to finance that amount. So the financing can be in the form of cash, or deferred payment, or maybe swap of share, etc. So what is the source of finance, and what consideration the buyer is willing to pay and the seller is accepting. That is important, and based on that the terms are decided. Then if during the diligence various red flags are highlighted by the legal advisor or financial consultant. So what are the mitigating aspect? What is the possibility of mitigating those? So let's say there are certain things, certain things which can be rectified through certain regulatory options like compounding, etc. So that is done. In case there is some financial issues, they may be adjusted against the financial or valuation of the company or shares. So those negotiation happens, and based on that, mitigating ways are determined. Then closing timelines. So what all regulatory challenges or approvals, etc., are required to carry the transaction becomes very important. So timeline is decided based on the mode of acquisition, the method of acquisition, and based on that, timeline is factored in. Then and that timeline, whether it is shooting to the company, target company or not, acquirer company or not, that is very important to understand. Then post-closing integration challenges are also flagged and decided at the time of acquisition itself, so that there is no later on disgruntlement between the new management and the old management. That is very important. So clear-cut discussion relating to integration challenges should happen in beginning itself, so that there is no post-facto discussion on that. So now comes, what are the major ways or methods of acquiring a business or a company? So one and simplest one is to acquire the majority stake or entire stake of the company. So we are talking about acquisition of a company. So mostly companies are controlled through equity shares. And if we are acquiring 100% equity, the business becomes wholly owned subsidiary. So that is the simplest and fastest way. However, considering the size of the transaction, there may be various approvals required. So like in case big size company, there may be a requirement to seek prior approval of Competition Commission of India. So that may be one of the way. Similar thing can happen in case of international acquisitions also. So those permissions and approvals are very important. Similarly, we have to see the whole cap table and whether there are certain shares which have special rights. So what consideration need to be paid to those having similar general equity and special class shares. So those need to be considered in detail, and based on that, timeline and costing, etc., is determined. At that time also, the tax issues are also flagged. So mainly the capital gain tax issues may come, and that too in the hands of the seller, not in the hands of the buyer. However, these are very important because it will be having cash flow issues, and sometimes it becomes a deal breaker also. So we have to factor in those aspects also very critically at the time of making the decision. Second part is second type of acquisition may be strategic investment with a long-term buyout. So many of the PE funds are also, or buyout funds are there. They are not taking the management immediately, taking the entire stake immediately, but they generally look for strategic investment, look for substantial investment with the right to buy balance shares from the existing management. This also happens in many of the cases where the business is run or business is dependent upon the founders or promoters of the company, and it is not easy to run the company without them. So in such cases, long-term investment target is made, and sometimes control is taken over immediately. Controlling stake is taken over immediately, and balance is given over a period of time with some earn-out payment method also, so that they have the existing shareholders or founders have interest to run the business in a good shape and grow faster. The other one is more technical, like to go for merger of the target company with the acquirer company. So this is also happening in many of the cases. However, the merger is the end game where all the assets and liability, everything goes under one roof, and the target entity is dissolved. So this is a more legal process and also time consuming. However, in many of the cases, they are tax efficient method to do the transaction. So merger can happen through in both the ways. Sometimes target company also get merged into acquirer. Sorry, acquirer company also may get merged into the target company. So that totally depends upon the regulatory approvals or the need for the continuation of the company, etc. So those strategies are discussed, and based on the decision is taken. Here, there is no cash outflow. The shares are allotted against the shares or issued to the shareholders of the target company, and hence no immediate cash outflow. And obviously, there will be no capital gain implication in the hand of the seller. So this may be a good strategy where there is a very high cash outflow, and if the acquirer company is a listed company and in consolidated basis, the seller's shareholders can get easy exit. In such cases, merger can be a very good step. Then there may be certain companies which are under distress or maybe under insolvency situations. So acquisition of those targets are also one of the way. So this may happen through and in Indian context through IBC process, insolvency and bankruptcy process, and that is also a way to acquire. There may be certain companies which are not under insolvency, but in the pre-insolvency stage where the bankers are willing to take someone to run the show and give exit to the existing promoters or some founders of the company. So in such cases, it can be a very good bet for the target company, acquirer company, and they can grow faster with enhanced capacity or enhanced market share with a very low cost. However, whenever we are going for acquisition of a stressed company, there may be certain challenges, regulatory or otherwise. There may be past dues. There may be certain regulatory issues. So those things need to be factored in while making decision with respect to the stress company acquisitions. Till now, I am talking about the acquisition of company as a whole, but there may be certain situations where only one part of the company or a business is acquired. So here the transaction happens through business transfer agreement or slump sale transaction. So this is very much similar to the first kind where shares are being acquired, but here shares is not acquired, but a certain business or certain unit of a company is acquired as a going concern basis, and the acquirer pays in cash in most of the circumstances, but in some cases the payment can be in the form of shares or securities of the acquirer company. So this will also require all those things, except that the share related diligences may not be required. The diligence would be mainly with respect to the assets or business or debtors, creditors, etc., which are getting transferred. So legacy issues would not be transferred to the acquirer. They will only take the business or the assets of the company. So these are the various ways to acquire the company or acquire the business under M&A transactions. I think I have covered most of the things. Now Ruchika would discuss more of the regulatory aspect of the same. Thank you.
Scott, can you just very briefly cover these aspects so we can have a complete transaction advisory to everyone? Ruchika, please.
Yes, sir. Thank you, everyone. Good evening, everyone. First of all, many congratulations to the entire corporate professionals team and the investment banking team who has put in their heart and soul for the launch of Deal for Business website. And I'm very sure and hopeful that this website would be a great source for deal matching and matchmaking for the corporate houses, business houses, and for the investment bankers who are looking for the match for their deal transactions. Now, coming back to the topic, inorganic growth. Of course, this is one of the fastest and easiest way to multiply your revenue, multiply your profitability. And as my co-speakers Sanchit and Manoj sir has already touched upon the trends and the overall process, which generally is to be followed, and the crucial points which needs to be taken care while implementing any such deal transaction. I would specifically touch upon the nitty-gritties of various transactions or various procedures which need to be followed when you are acquiring any listed company or when you are merging with any listed company. And then I would touch upon certain sectoral, approvals which are required for any transaction. So, coming to the topic, as my co-speaker, Mr. Manoj, has touched upon that there are various modes of acquiring a company. It can be either by investment of certain funds in the company, or it can be by acquiring majority stake in the company, or by acquiring certain percentage in the company. It can also be done by way of asset purchase in any company, not by acquiring the overall company, but acquiring only specific asset, and can also be done by way of merger. So in each of the transaction, there are certain regulatory, provisions which gets triggered when you enter into those transactions. So if I talk about listed companies, and if specifically the acquiring company wants to acquire certain stake which is not going beyond 25%, then probably when you're acquiring a listed company, you will have to make certain disclosures as per SEBI LODR regulation, listing obligation and disclosure requirement regulation. But when you go beyond 25%, then SEBI takeover regulations comes into picture, and then you have to make an open offer to give an exit opportunity to all the shareholders, all the public shareholders of the company who are there, who have invested their money in the company, and they can choose whether they want to continue with the new management or they want to take exit. For that, the acquirer needs to give a fair offer price along with the fair offer size, and needs to follow the overall process. This process requires an observation letter or a sort of approval from SEBI, which takes time of nearly 4 to 5 months if there is no sectoral approval involved in such transaction. So we have discussed about what all the things you have to take into consideration before entering into the definitive document. Now, this is when you enter into the definitive document, and post to that, what all things you need to follow. So it becomes crucial for the entire, legal as well as secretarial team of the target company as well as of the acquirer to see what all things will get attracted, and to keep the check of all the points that need to be ensured before entering into the definitive document. You need to appoint the merchant bankers, you need to appoint various other agencies, and you have to make an open offer, and then you can trigger the transaction. If the acquirer company is not going into an acquisition and want to venture directly into the merger process with a listed company, then as Manoj sir has mentioned, it can be done through direct merger of two companies, and both the companies become one. It can also be by way of reverse merger. It can also be in a way that some part of the target entity gets demerged and then further merged. So there can be various, ways of scheme of arrangement through which the companies or the businesses can be acquired. For the overall merger process, if listed company is involved, there are certain procedures which need to be followed. First of all, the valuation report need to be taken from the registered valuer. On that valuation report, a fairness opinion is required from the SEBI registered merchant bankers. There are certain thresholds which are given by SEBI circular that on fully diluted basis, the minimum public shareholding should not go beyond 25%. The scheme in which you mention the exchange ratio and the rationale of the scheme, that needs to be approved by the audit committee and the independent directors of the target company. And post to that, if listed company is involved, then the application is filed with the stock exchanges under the SEBI LODR regulations, and then the stock exchange as well as SEBI approvals comes into picture. Once it is in hand with the target company, then the first motion application with the NCLT is filed. Court hearings and the procedure follows on. In this process, the shareholders approval, creditors approval, and the NOC from official liquidator, income tax department, and if any sectoral regulator is involved, then those approvals are sought, and thereafter the merger process and the second motion application is filed and the merger process gets completed. So this is how you can acquire a listed company. It seems very simple, as I say and as you hear, but it is not as simple. It takes time of nearly 8 to 12 months. And in case we talk about acquisition of an unlisted company or a merger with an unlisted company, then probably the approval from SEBI and stock exchanges eliminates, and the timeline and procedure gets slightly easier in comparison to as it is in the listed company cases. Now coming to specific, approvals which gets triggered in various sectors. So if I talk about that if any insurance company is being acquired, then you have to take approval from IRDA, and all these approvals are prior approvals. When you enter into the definitive agreement, you have to mention that it is a condition precedent. Once these approvals are in place, then only you can consummate the transaction, you can complete or close the transaction. So in case of insurance companies, IRDA approval is required. If it is a telecom company, then Department of DOT, the Department of Telecom approval is required. If any specific pharma related company is there, and there's a specific drug which requires approval from the DGC, the pharma department, then probably Drug Control General of India approval is required. If RBI if there is an NBFC, then the Reserve Bank of India's approval is required. So all these approvals comes into play, and until unless these approvals are not received, the acquirer cannot do the business in the target entity. They cannot reap the benefits, synergies which are there. In a very few cases, and which are very large in the size, the approval of Competition Commission of India also comes into play. So it gets generally triggered when, as per the Competition Act, the merger or the acquisition of both the companies may impact the competition in India. So these things need to be taken into care before entering into any definitive document. As I have read, and as my co-speakers has also already mentioned, even when the slump in M&A transactions came from 2022 to 2023, India was not, at that slump. India was still growing. So I think there is a lot of potential in India for the M&A transactions, and considering the growth here, government is also taking a lot of decisions to streamline the process and the procedure so that it can be done in a very easy manner, and it may not hamper the overall commercial plan or the overall synergy plan of the companies which are entering into these transactions. So that is all from my side, sir. I think.
Okay, thank you, Ruchika. Thank you giving this analysis. Now, friends, as you are aware that we have shown you the inorganic acquisition, how it takes place, what is the process, and what you should do, and what are the technical points. Now, it's time that we should see that how market understand this, how the market can utilize this. So how the market see this, and how this acquisition gives a value addition and value creation to the company. So we have a very learned speaker with us, our Arun Malhotra. He is in the market in this particular expertise and interestingly, Arun is an engineer and he has done then stock market research analysis and MBA course from international organization, and he knows the in and outs of every company, every transaction, because he is in deep into this. So over to you, Arun. You just explain to us that how this inorganic growth resulted in value creation or value destruction as per your experience in the market. Over to you, Arun.
Sure. Thank you, Pawanji, and thanks for inviting me. And congratulations, a big congratulations to the whole corporate professional team for doing excellent work on the transaction advisory piece. So I think that today's topic is very interesting and it's very core to my heart, which is the inorganic acquisitions. All of the previous speakers, including you, Pawanji, have explained why do we need acquisitions. Basically, it is faster growth. The growth can be in the form of a higher market share. It can be in the form of geographical reach. It can be in the form of maybe more clients. It can also be if number one and number three player in the industry are merging. or number one and number two players are merging so that the competitive pressure is less and they can actually now have a better pricing power, which we also call it industry consolidation. So these are some of the reasons why companies go for inorganic acquisitions. And you name any company in the Nifty 50 today, everybody would have taken this acquisition route. You take Tata Steel, you take Tata Motor, you take Infosys, you take Bharti Telecom, you take Reliance Industries, you take banks. Kotak merged with ING Vyasa. They have also been, banks have been also buying, NBFCs. Then SBI, all four SBIs were merged. So whatever sector you take, inorganic acquisitions is a core part of every company's strategy for growth. I will give you a couple of examples, which are running as on day to day. Ultratech have announced two acquisitions recently. One was Kesharam Industries, and another one in India Cements. So just taking a step back, why did they acquire India Cement? They were not present on the southern side. And India and Ultratech was mainly on the western, on this, little bit on the southern, but mainly on the northern side and the central and eastern. So they wanted to acquire an asset on the southern so that they can have a higher geographical presence. Another one example I want to give you is PVR and Inox. Number one and number two player have merged. So industry consolidation. Now there is one very important factor in these mergers, is especially these horizontal and vertical mergers, is the cost synergies. Just imagine Inox and PVR, taking a lion's share of the market, of the distribution market, and now they are in a much better negotiating position to negotiate with the movie producers how much they will share or how much they will actually part with them, or they have already increased their pricing. So these are some of the things that leads to better market share, better profitability, and these cost synergies are very easy to come. Idea is a result of merger, Idea Vodafone, and everywhere you see, these mergers are happening. I also want to add one more factor why companies acquire companies is to acquire capabilities. Nowadays, AI, machine learning is, I think everybody is is the buzzword for everybody. So IT companies are acquiring these small startups just to acquire capabilities so that with their existing clientele, they can actually use these small setups, those capabilities, to showcase their existing customers that they can also do something on this machine learning and AI front. Recently, Coforge, a listed company, acquired Signity Technologies. Signity is big in testing, while Coforge has a lot of clients. So you can see actually both the capabilities of these companies are complementary to each other, and hence you will have a higher revenue growth, you will have a higher profitability, you will have a faster reach to the whatever milestones these companies have done. We have also seen MNCs coming and acquiring Indian companies and then merging their overseas subsidiaries with this. The recent example is Root Mobile is being acquired by a company called Proximus, which is based overseas, and they are merging their Netherlands subsidiary with the Indian subsidiary. So there are n number of examples, and if you take and analyze all those acquisitions, the underlying principle is the same. Cost synergies, market share, geographical reach, clients to have a higher profitability. One other angle which I want to give to these inorganic acquisitions is, obviously the underlying principle is growth, but when companies acquire other companies which are totally into unrelated sectors, which we call it diversification. And the best example is recently PCBL, Philips Carbon, acquired, which is into actually carbon black, which is used in tires, and they have been a market leader for the last 40 years. They going and acquiring a totally unrelated business in the aqua business, which is water purification and all. So and the underlying principle is The existing business is a cash cow for them. It generates a lot of cash, but it does not have redeployment, opportunities for them. So they went using this cash flow and little bit of debt, acquiring another company, another business which has tremendous potential. So these are some of the things which go into the minds of the company's managements, why they should be acquiring. What does it involve? As stated by previous speakers, I think from the capital market point of view, one negative thing is upfront it involves costs. The benefits accrue later. They are back-ended. Once you merge two companies, there can be cultural issues. There have been issues in the past. There can be balance sheet issues because you need to incur debt to acquire companies, and the economy goes down. The debt actually reflects on the balance sheet, and your leverage goes high, and hence your total equity valuation goes down. So what is very important, what is very critical is at what price you are buying this. This price can be paid in the form of cash or in kind. You can exchange shares. It also leads to dilution of the control of the existing promoters. So that is also a factor to be seen. And a lot of times it impacts balance sheet because you are also incurring debt. So these are some of the factors that you need to take into consideration. Next thing I think I want to touch upon is I'll give you a couple of examples which are running right now. But how do capital markets look at it? I think in the short run, if the price paid is much higher, then you would see the company of being the company which is acquiring that. The market perceives that it is overpaying for this asset or overpaying for the growth, which is going to be back-ended. So the price may come down, while if it is a listed company and it is being overpaid, so the target company might go up. And there is always an arbitrage between the two because as previous Ruchika said, there are regulatory approvals. So that takes anywhere between maybe 5 months to 6 months or 9 months, depending upon the complexity of the transaction. But there always exists an arbitrage of 5-6% to 10% where you can actually buy one and sell the other. So these are some of the tenets or some of the things that capital market players look at. But worldwide, if you see, these acquisitions are a significant and a core part of every company, every fund. And there are specialized buyout funds that will actually help companies acquire assets. So for financing, and that finances can be hybrid. It can be a mix of debt and equity. It can be a mix of preferential, everything. So that kind of hybrid financing is available with a lot of private equity guys who would actually help these companies acquire targets. Now, last thing which I want to touch upon is this role of these private equity players. What are they doing? Actually, they are one of the biggest facilitators of these acquisitions. And why I say that? Other than obviously the capital market, because once a private equity buys a company, they have a life cycle of 5 to 7 years of a fund. They have to exit that company in 7 years. If they just focus on organic growth, then it will be maybe, let's say, 12, 15, 18% max to max. But if they have to be a multiplier of their investment, they want some multiplier of their investment, they have to show a higher growth. So what they do is, as soon as they acquire company X, they will keep on adding smaller or mid-sized companies to that company X and make it a bigger, so that in 5 to 7 years' time, they will have two components. One is the organic growth, which was there, which is 15%, plus acquisitions through the inorganic growth. And then using the cost synergies, because they are on the board of that company, they are a private equity player. And using the cost synergies, they will enhance the margins. So just imagine 15% growth from their original company, then additional growth from acquisitions, and then combining those entities for cost synergies to have a much higher margin profile and a profitability, leading to the size of the company becoming bigger. So the price to earning multiple getting bigger. Normally for a small size company, PE would be small, but for a bigger size company, the PE would also actually rise. So if you see, there are 3, 4, 5 levers for a private equity guy to go for acquisitions. And this is the core of their strategy. How do private equity players make those kind of IRR returns? This is their strategy. And since they also have overseas leverage, means they might have offices like Blackstone, TPG, they have offices all over the world. They will use the knowledge, the capabilities of their overseas arms and other expertise to make sure that the growth in their local entity is much higher than what the industry growth is. I'll give you an example to support this. Recently, our Systems International is being acquired by Blackstone, has been acquired by Blackstone. And Blackstone has a portfolio of around 250 companies. So our System International is going to those existing 250 clients which are already there in the domain, that can we provide you services? So they already get a captive client base of 250 clients for a higher growth. So these are some of the things that which are used by buyers, buyout funds, just to make sure that there is a higher growth going forward. I think I'll take a pause here, Pawanji, and happy to take questions.
Okay, thank you very much, Arun. Thank you for giving the indication that organic growth is how it helping. The most interesting part which you have suggested, because sometimes what is happening, some company announce that I'm taking over this company and suddenly rate is going down. So you have very well explained that, because first it's a cost, second is a valuation, because sometimes people think it's a very high cost, but sometimes because result will come after so many years. So always investor asking us that, sir, why the share price has gone down when they have taken over. So you have given some logic, but any other thing is there. When you acquire some company, you mentioned about the cost, you mentioned about the valuation, but sometimes they do share swap.
Yeah.
Now share swapping is doing that there's no cash outflow.
Yeah.
And you are creating. So in share swapping, people, investor, I'm talking about the retail investor, not the market investor. Market investor also sometimes confused. Even then the rate is going down. So share swap deal is good or bad?
See, share swap deal is good from the balance sheet point of view because there is no debt or cash involved. But even if you are paying a higher valuation, whether you pay it in cash or in kind, it doesn't matter, because you have, let's say, an asset value is 1,000 crores. You have paid that company, valued that company at 1,500 crores. Whether you pay that in cash or in a share swap, the fact is 500 crores of excess surplus has been transferred to the target company out of your own company, which you will be paying. And hence, this 500 crores, the market cap will, EV of that company will come down by that. So it is just a function of, and hence, since I said the benefits are back-ended, most of the managements, when they are in bull markets, good markets, they tend to overpay because there are so many buyers and they are looking at 5 years. And that's where in the short run, the market price will actually come down.
Manoj, you have view on this when you do this type of swap transaction. In your opinion, as a technical issue, what are the issue you encompass and you encounter and you feel that sometimes this transaction is not going through, even then you are not paying any outflow of cash, even then people are shy away to give equity-based transaction?
Yeah, so I think Arun sir has clearly said, and that is the most important. What is the perception of value for by the investor community, and what we are paying? The management generally go for looking at the long-term benefits, and those benefits may not be perceived by the market or smaller investors, because they look for what is the immediate impact on the balance sheet, what will be the interest cost if loan is being taken, or the capital base is increasing, so what will be the impact on EPS of the company immediate basis. So those factors would be considered by the investor at large. whereas the management would have a long-term view that this acquisition of, let's say, certain capacity is there, which is not unlocked by the target right now. But after coming into our fold, we may use that and grow faster in a longer run. So those benefit would we incur over a period of time, and hence we are ready to pay. But those payments would happen today, whether in the form of cash through some bank financing or internal accrual, or through issuance of new shares. In all such cases, investors tend to reduce the value or start dumping the shares in some cases. So that may be the reason.
Okay, Arun, just now you have mentioned that PE fund, there are two types of PE fund. One is they are investing, and then they are investing in various companies as an investor. One is you gave recent example that they take over the company, put their person, grow it, and then create value. Because money is not a problem for them. Only thing is that growth is a issue, and in the growth also you require good team. But remaining business, bringing synergy, that is also in their fold, because they have 250 companies they in the fold on other companies also. So how this model is successful in India, and what do you think in future this scenario will change? And scenario will change the capital market space.
See, this was used to be not existing maybe 5 years ago. But as we say, India is a growth market because most of the demand is here. So most of the global private equity funds are entering India with this strategy. Last week, I was attending Bearing Private Equities and similar model. They will acquire company one, help them grow by showcasing this company to their existing portfolio of companies, and then trying to get synergy in revenues. Let's say there's an IT company, a services company. This company can provide services to how many clients of my, in my portfolio. If I have 200 companies globally in my portfolio, now I have acquired a company for which there is already a captive client base of 200. And this is a very, I would say, a low-hanging fruit for them, because they don't need to establish credentials. They are already there is a common owner. So since you don't need to establish credentials, this is a low-hanging fruit. Lot of companies, actually, this is strategy one: acquire and use your own client base. Second is then go for inorganic acquisitions, which take time, because a lot of times you may not get the right opportunity, you may not get a right price.
Okay.
It's not that opportunities are available always. Opportunity may not be available. If it is available, the price may not be right. Then how will you make economic returns? You can go and buy anything at any price, but you will not be making economic returns for your equity shareholders.
Okay. Manoj, there is one question. Suppose a slump sale is carried out in the scheme under Section 230 of Companies Act, consideration can be by way of cash or shares. The proposed acquirer pay rupees X as consideration. As per SEBI Master Circular of M&A, there need to be a valuation of the undertaking. How can these two figures be reconciled? Whether this means that the offer by the acquirer should always be higher than the valuation of the exchange ratio is based on the said offer and not the valuation.
So now, basically, SEBI formula or SEBI circular does not specifically prescribe the method of valuation. It is only talking about the three approaches to be applied. So if let's say negotiated price is X, obviously there should be some basis for the same, and if the basis is correct, then applying the three approaches, that is the market approach, the income approach, and the asset approach, the valuation may come within that range, and then the transaction can happen. However, if we are if the person is paying much higher or lower than what is the fair value, then obviously SEBI would question, specifically if we are paying less to the shareholders of a listed company. So
Okay.
it has to be balanced.
Okay, whether such shares can be issued by a listed company or only by an unlisted company in case
So
of.
right now, private placement or preferential allotment by a listed company to acquire any asset is not allowed. As per ICDR regulation, only for buying out of shares of other company, a listed company can issue shares under preferential allotment route. But under merger or scheme of arrangement, anything can happen. Yeah.
And whatever the should CCA approval.
I think CCI it may be
uh,
talking about that depends upon the threshold prescribed under the CCI norm. So if that threshold is getting met, you have to approach CCI for their pre-clearance.
Okay, we are currently reviewing the inorganic growth and would like to explore in more depth the various tax exemption and long-term taxation benefit that may arise through these strategy. Specifically, we are interested in understanding the avenues available for optimized tax structure, exemption, or other financial advantage that we could leverage as a part of growth initiative. So, Manoj, in this case, the question they are asking, maybe there's a loss-making company or you are a profit-making company if you are acquired. Okay.
Yeah. So
Yeah.
yes.
What do you think?
So that can be one of many of the objects. One of the object may be tax mitigation or reducing the tax liability. So if you are acquiring a stressed company or loss-making company where there is accumulated losses and you acquire those company and merge into it yourself, then you can take advantage of the carry forward losses or unabsorbed depreciation losses, though that benefit can arise.
Okay. Arun, just tell me, when we are acquiring, so like there's a profit-making company and it's acquired loss-making company, and they are a carry forward losses. So the profit-making company, which is a listed company, there's no need to pay tax because this adjusts. How as a investment point of view, you see these companies as a good strategy, better because there's no tax after earning.
See, normally, my personal view would be that just acquiring a company and availing the tax benefits can be a strategy. But acquiring a company only for tax benefits may not be looked rightly by the capital markets.
Okay.
So if you acquire a company, it is in distress, and we all understand that this company will take some time because it has been in losses, some time for restructuring, for recovery, then yes, the markets will wait for 3 years. And then on top of it, the benefits would be because you are making a lot of efforts and costs in restructuring that company. You will be using your balance sheet, my equity to restructure that company. So I am willing to compromise on that loss for 3 years till that company revives. And for that, for that compromise which I'm making for 2-3 years, the tax losses in the new company will compensate me for that. So it's a very good strategy if you combine both of them.
Okay. But your point is you should have a business.
Yes.
You should play on business, not on the balance sheet only.
Yes. It should be a business case.
Business case, Paul. Yes.
Acha, okay. Now this question, Sanchit, the Tata Motors has acquired Jaguar Land Rovers, and they acquired Chorus also. When they acquire these companies, what initially there was a bad in the market was not taking positively. So what is your view why this has happened? Then Arun and Manoj will give answer. Yeah.
Actually, with every acquisition, there are certain positives and negatives to it. Wherever, in case of Tata Motors, when Jaguar and Range Rover was acquired, it was not taken in a much more in a way that the business will grow. However, with the acquisition of Range Rover and Tata and Jaguar, it actually increased the technological aspects into Tata. The engine capacity, engine quality increased much more. That is what Tata foresee. And that is what actually helped in increasing the market share and increasing the quality of cars as well.
Okay, Arun, your view on this particular thing, because first when they have taken, share price has gone down badly.
So two things. I think timings for both Motors and Tata Steel acquiring Chorus was wrong. And if you see when they acquired Jaguar, the UK market went down. Their own commercial vehicle, which was the cash cow for them, started doing badly, and hence they thought that they would be able to buy this Jaguar through the cash flows of the existing business. Only even though Jaguar was a much bigger, so they acquired debt to acquire. And these Jaguar companies like Jaguar, and they require at least $1 billion every year in capex for redesign. They have to come out with a new model every 1 year, 2 years. So when the cycle turned down, their domestic business went down, their Jaguar business down, and on top of it, they had to invest in capex because you have to be in the business and come out with new cars, whether it's down cycle or up cycle. Same with Chorus. Chorus, they were little unlucky because there was an issue of cultural issues also. You cannot fire in the UK plant. So if you cannot fire, if you cannot take cannot do cost rationalization, steel is after all a commodity business. For a commodity business to survive, you need to be the lowest cost producer, which you cannot be in a country like Europe. So their costs were higher and steel prices went down, and hence your margins, you were not even able to cover your fixed cost. So you had to shut some of the plants, ask some of the workers to retire, which you couldn't do because then it became a cultural issue. An Indian company coming to Europe and firing, white people, and hence they had to actually, close down and give it back.
Okay. Manoj, you have any call in this type of transaction?
I think whenever there is a very big acquisition, there is always a gap between the expected valuation, expected perception about the benefits and actual benefit which the internal people believe on. So that is the biggest challenge for the market. Like in case of these brands, the brand were very good, but obviously the cost of production or the investment required, continuous investment required was very much higher. So obviously market believed that it may not be helpful to Tata, which were generally producing the commercial vehicles and passenger vehicle of lower end segment, whereas these were premium brands for which continuous upgradation and etc. was required. So considering all those factors and considering continuous cash investment, I think market thought it is not a good buy for Tata
Okay.
Motors.
Arun, now come to the so many startup are coming in India or internationally.
Yeah.
And I gave an example of Sesam. The Apple has taken over this company. Okay. Sesam is when we were. So
Yes.
whenever there is a music, you just that your phone can listen and tell which song it is. Okay. Now Apple has taken over. Now Apple is far ahead in so many other things, but simultaneously it is also lagging behind in so many things. Okay. So these small companies which are niche area, which can create a big impact on your larger game. So previously people were forming a company for a larger interest that I have to make big. But now when this is happening, like Zomato is taking over small companies, something is technology, something is a specific market. What do you feel in future? These startups which are starting, because now startup is coming and asking, sir, we will make a company and not for the business, for acquiring, for the opening for any big company can acquire us. So they want to create some niche area. So this trend is good also, and this trend is bad also. So what is your view on this?
See, Pawanji, first of all, human minds are entrepreneurial. So they will keep on actually innovating something. And you asked me why Apple is acquiring small companies, these startups are being acquired. The prime reason is that for them it is a loose change. What they think is, if I don't acquire and this company has a good technology and becomes bigger, it could actually be either be acquired by a competitor or could become a bigger competitor for me. So they just keep on acquiring these small companies. I give you an example in the Indian context, Zepto. Zepto was started by two college guys in the 21 years.
Yeah.
And they just started this company post-COVID in 21. And they
Yes.
are now worth $5 billion, giving and looking at this, Zomato acquired Blinkit. So now, now people are looking at maybe Walmart or maybe Amazon is looking at Zepto. Because instead of both of them getting combined, rather I acquire them and expand my business. So there is, because capital is excess available for these companies, either in cash or kind, like companies like Apple have thrown tons of cash every year. So they are just acquiring these companies. And I think this is a very healthy development in the startup space, because entrepreneur bent of mind thinks, if XYZ can do it, I can also do it. And hence you are seeing a lot of innovations happening, especially on the technology side, on the healthcare side, on the fintech side.
Okay. Now, what is happening? Like take example of Reliance. They acquire Future and Netmeds. Now, do you see in future, like Walmart is there in the world, very few companies are remaining. Other companies are becoming a giant. So in India, we have a multiple business, multiple market, multiple startup and everything. Now it is taken over by big companies. So do you feel in future, if you say e-commerce, then one company is there which has acquired everybody and managing this. So what do you see the future of this indirect acquisition and impact on Indian market, impact of Indian things? Because I'm just, and as a socialist, I'm talking that in future, if all these things are coming under one hand, then where our people will go and how the market, because market is not only seeing this, that okay, I am investing in this company, so this company is growing, is good, but people are seeing today ESG also, people are seeing sustainable development also, people are seeing inclusive growth also. But when this type of company is acquiring, how as an investor, how as a fund manager, you feel to invest in these types of company, which ultimately taken away business of the small people? Very, very tricky question I'm asking.
Yes, Mohanji, I think this is very common, and this is that biggies will become bigger, no
Yeah.
doubt about it. And the smaller one, either they will die out or they will get acquired. Because what drives businesses nowadays is capital. Why Future was, became a bankrupt or whatever we know it today is there was a competitor who was much bigger in size, much bigger in balance sheet. Same happened in telecom. That you have a competitor because of predatory pricing, because of pricing which was lower than the cost for the current incumbents. The existing players are not able to survive, and neither they have the wherewithal in terms of balance sheet, neither capital, nor promoters willing to cough in a lot of money, and hence they will actually they die down. So this is a very common phenomena which is happening even in developed markets, and India is just catching up. You see banks biggies are becoming bigger. Even in PSU banks, the government came forward and actually merged three banks to make them bigger, realizing the fact that they can face the competition going forward. Otherwise, those small private banks would have died their small PSU banks would have died their own natural death. So this is a very common phenomena that as markets mature, the size matters. For innovation, there will be smaller companies, incubators, but sooner or later, because they would require capital, either they will be initially funded by VCs and private equities, but subsequently they will be, because private equity also has to take an exit, and hence they will be selling it either in the public markets or to somebody else to provide them the necessary capital for further growth. So this is a very common phenomenon.
Okay, you have mentioned about the telecom. I'm asking the same question on telecom. There was an inorganic growth idea was there and Vodafone was there. Both
Yes.
merged. Okay. And with this merger has not giving the desired result. So
Yes.
sometime when we talk that inorganic growth is always successful, then answer is not always.
Yes.
Because so many other things are there. So can you just tell me why the Vodafone and idea is Vodafone is a when we were going to abroad, Vodafone was the only in UK Vodafone in UK phone. So when it is coming, people were thinking that they are coming with a large pocket. Okay, deep pockets they have, but it has resulted into neither they brought out technology nor money, and today idea is breeding and they are facing problems. So what is there is it not a something dark side of the inorganic growth?
Yes. So as I said, the inorganic growth, it's not that every time it will work out. These two companies merged, but there was a bigger player in front of them who had a technological advantage, who was a later entrant, had a unified license, had a technological advantage, and hence their pricing of ARPU or revenue was much lower than even the costs for the existing players like Idea. So
Yes.
their pricing, we call it, some people call it predatory pricing, some people call it lower than the cost, but that cost led to huge strain on the balance sheet, because just mind, what is the raw material for a telecom player? It is the spectrum which they have paid to the government, and they were not able to recover the spectrum costs even. So they were devoid of their raw material, that they were not able to pay for their raw material because of the pricing. And hence this debt kept on ballooning. And what does it happen for a company which goes into a debt trap? Even the most precious customers leave them, because then there is a problem of underinvestment. If my problem, I am not able to make money, I will underinvest in my businesses because I have to do technological upgradation. If I was not able to do technological upgradation, so there was a lot of congestion in the Vodafone
Yes.
platform. And when the congestion was there, the premium customers went away. So it's a vicious cycle. You are strained on the balance sheet, the pricing is low, your most precious customers, means the most premium customers who are paying you a higher postpaid customers, they are leaving you. Only the 49 rupees wala jo customer that is remaining with you. He is not at all profitable. So it's a vicious cycle which you get trapped. Hence, as I said, biggies, what they do is their entry strategy is go at a pricing which is lower than most of the people and eliminate the players. Rather than fighting them, you eliminate. That's
Right. I think, sir, the technological advantage, the advantage, policy advantage was also in favor of Geo, because the unified license came and the technology they have acquired Hathway and Den Cable, and their telecom were also used, which were much cheaper than any of the telecom players. So they had the big advantage towards the payment payout for the spectrum, and that's why they were able to kill everyone. Obviously, deep pocket is one of the reason, but yes, that was the biggest reason.
Okay. So now, thank you, Arun. Thank you, Manoj. Thank you, Sanchit. Thank you, Ichka. It's time to close because we always try to maintain the time. So, as you are aware, that today we are completing our 188 webinar. So, this journey of knowledge sharing is going on and continuing. So as a ritual, we are closing this session. So I'll just take 20 or 30 seconds from everyone about the topic. What is your call take on this? I'll start with Ruchika.
Thank you, sir. So, as I mentioned while I was presenting my topic, it is very important for all the teams and all the internal teams, all the internal separate teams to be ready for the transactions, because it's just not about the promoters entering into the transaction and doing it and making synergies out of it. If you miss out on any one point, it can hamper your prices, it can hamper your brand, it can hamper your visibility. So I think making notes to small and smaller points and taking steps, leaps on the basis of that is the key to succeed in any deal transactions.
Okay, Sanchit.
With respect to today's topic, I think inorganic acquisition is the way to go forward for anybody to rapidly grow. Yes, definitely the old and traditional ways to take organic growth is considered old now, but we have seen today in the new culture and new companies are growing very rapidly, very fast by joining hands with other companies, acquiring them, adding their top line, adding the diversified management expertise, the technology, innovating with respect to that. So I think it's a very great strategy to grow into any industry and be a top leader. Obviously, it comes with its own challenges, but I think if at all there is a capacity for any company, they should definitely look into that.
Okay, Manoj.
Yeah, so M&A is always a very, very important strategy for any corporate to grow, and it will continue. And in fact, as Arun sir was telling, as soon as the funds are coming, the private equity players are coming, there will be a lot of consolidation, lot of acquisition and deals will happen and continue to happen. However, it is very important to find right target at the right price so that growth happen, value unlocking happens for the investors and the shareholders. So that need to be taken care of while deciding on any M&A deal. I think you are mute, sir.
Arun, your last word.
Yeah, so I think just to sum it up, inorganic acquisitions are a significant part of capital markets. They will continue to grow. But mind you, all acquisitions are not good. You have to evaluate them. And for the point of view that which acquisition will create economic value for the equity shareholders.
Okay. Okay. Arun, so thank you very much all. Thanks. And as I told you that our journey of sharing knowledge will continue. And our next webinar is 189. That is a very interesting topic, corporate proxy advisory firm, champions of corporate governance or obstructionists, whether they are creating a governance or they are creating obstruction. So this is the topic, and we are invited all the 4 proxy advisors in India. Amit Tandon will come, Mr. G.N. Gupta ji will come, and the another company that all both, one is international and other people will also come. So I request all of you to join this. So friends, before closing this, I just want to tell you that today is Ganesh Chaturthi. So happy Ganesh Chaturthi to all. And today is a very auspicious day. And today we have launched our deal for business site. So hope that this Ganesh Chaturthi will bring lots of good wishes and happiness for everyone, and especially we have launched the deal for business today, so we'll get blessings of Lord Ganesha. Thank you very much. Till then, goodbye.
Thank you.